Are you planning to buy a house but feeling overwhelmed by the different types of home loans available? Do you often find yourself asking, FHA, conventional, which is the right choice for me? If so, you landed in the right place. Today we're going to take a deep dive into the mortgage tug-of-war between FHA and conventional loans. We'll weigh the pros and cons of each, lay out the qualification requirements, and provide some practical examples about FHA versus conventional. Whether you're a first-time homebuyer with a limited budget or you're an established buyer with a stellar credit score, this video will shed some light on which loan might be best for you. So buckle up as we decipher which one is better. First, let's talk about FHA loans. The FHA, or the Federal Housing Administration, was created in 1934 back during the Great Depression. Their purpose? To help increase homeownership in America by offering insurance to lenders, which in turn led to more lenient lending standards. Fast forward to today, and FHA loans are a popular choice for many, especially first-time homebuyers. These loans come with a major advantage. They require lower down payments, often as little as 3.5% of the home price. FHA loans also tend to be more forgiving if your credit score isn't quite perfect. However, they do require you to pay mortgage insurance premiums, which can add to the overall cost of your home. Then on to conventional loans. Conventional loans are any type of a home loan that is not insured or guaranteed by the federal government. Now, they're bought by Fannie Mae or Freddie Mac, but they're not insured or guaranteed like an FHA is. This sets them apart from the government-insured FHA loans we just discussed. Conventional loans are typically offered by private lenders like banks, credit unions, or mortgage companies. They can require a higher credit score and a larger down payment. They're very much more credit sensitive. They usually start from 3% going up to 20% or more. But here's the kicker. You can manage to put down 20% or more, and you can often avoid paying PMI altogether. In a nutshell, FHA loans are backed by the government and are more accessible to those with lower credit scores or smaller down payments. On the other hand, conventional loans are not government insured, require a higher credit score, and can be cheaper in the long run if you can afford a larger down payment. Before I move on to my next tip, a little bit about me. My name is Emmett Dempsey, mortgage broker and owner of Treasure Coast Mortgage here in sunny Port St. Lucie, Florida. I'm a licensed loan professional and I actually do mortgage loans in this chair each and every day for families like you. I'm not just a spokesperson. If you could do me a favor and smash that like button to help the YouTube algorithm distribute videos like this to folks like you, who want to learn more about mortgage and real estate topics. And don't forget to hit that subscribe button as well. Also, make sure you click the link in my description box in the comment section below, because I have a free guide about things to consider when buying a home. This free ebook will walk you through the several frequently asked questions that many buyers have in this current market and help you give you some clarity to move forward. Again, make sure you click the link in my description and the comment section below. Now, with that out of the way, let's continue. So now that we've outlined what FHA and conventional loans are, let's delve into the qualification requirements for each of these loan types. Starting with FHA loans. The qualification requirements are generally more lenient. Firstly, the credit scores. For an FHA loan, you're usually looking at a minimum credit score of 580 to qualify for a low down payment of 3.5%. If your credit score falls between 500 and 579, you can still qualify, but you need to make a larger down payment of 10% or more. And of course, you still need a steady income that's going to sufficiently cover your mortgage payment and any existing debts. The FHA will also consider your debt to income ratio. That's to your monthly debt payments as a percentage of your monthly income. The front-end ratio of the mortgage payment, FHA likes to stay around 45%, but your back-end ratio, which is all of your debt, can go as high as 56% if needed. Now let's turn to conventional loans. For a conventional loan, lenders typically look for a credit score of 620 or higher, although the best interest rates are usually available to those with a score of 740 or more. Conventional loans are also require proof of a stable income and certain debt-to-income ratios, typically preferring a ratio of 36%, although some lenders may allow a ratio, you can go as high as 50%. Your down payments can vary, but as I mentioned before, a 20% down payment allows you to avoid PMI altogether, or you can buy out your mortgage insurance, unlike FHA loans, which is mandatory. As you can see, while FHA loans can be more accessible for those with lower credit scores or smaller down payments, conventional loans might be more appealing to borrowers with a solid credit history and a larger amount to put down. It's crucial to consider your personal financial situation and long-term goals with this house when deciding between these two options. Let's now look at the pros and cons of FHA loans, because like most things in life, they come with their own set of benefits and drawbacks. The key benefits of FHA loans are their low barriers to entry. If your credit score has been taking some hits, or if you're not available to save up for a large down payment, FHA loans provide a pathway to homeownership, and there's some down payment assistance programs available, mainly for FHA loans. They require a lower minimum credit score, starting from 500, and allow a down payment as low as 3.5% if your credit score is 580 or higher. This is quite helpful, especially for first-time home buyers. Additionally, FHA loans can be more forgiving with higher debt-to-income ratios. You're making a viable option even if you have other debts to manage. However, it's not all sunshine and rainbows, guys. There are certain limitations and costs associated with FHA loans, and these limits vary by county to county. If you're in a higher price housing market, this can be restrictive. I know here in St. Lucie County, it's a little over $500,000, versus the conforming loan limit, which is over $700,000. Secondly, FHA loans require both upfront and annual mortgage insurance premiums. This insurance is a safety net for the lender in case a homeowner defaults on their mortgage, but does add to your monthly payments and the overall cost of the loan. Since FHA loans offer an accessible route into homeownership, particularly those with lower credit scores or smaller down payments. But keep in mind the loan limits and the added cost of the mortgage insurance when considering this option. Now let's shift our focus to conventional loans. Just as the FHA, conventional loans come with their own set of benefits and drawbacks. Starting with the benefits. The major advantage of conventional loans is the absence of any upfront mortgage insurance fee. If your down payment is less than 20%, you will have to pay private mortgage insurance, or PMI. At that point, you can request to have your PMI removed, potentially leading to a lower total mortgage insurance payment over the life of the loan compared to an FHA loan. Also, conventional loans often have higher loan limits. Right now, it's $726,200 is the conforming loan limit versus $500,000 in my county. So if you're buying in that price range, it can really affect you. And conventional loans do have their own hurdles. They often have stricter credit requirements, usually requiring a minimum credit score of 620. And while you can get a conventional loan with a down payment as low as 3%, the best terms are typically go to borrowers who can afford a down payment of at least 20% or more. And the more you put down, the better rate you get. It's also worth noting that if your credit score is on the lower end, you may end up with a higher interest rate. Conventional loans are very credit sensitive. So while conventional loans can be an attractive option for those with a good credit score and the ability to make a substantial down payment, the stricter requirements may pose a challenge for others. As always, it is important to weigh these factors against your individual circumstances and decide which loan type is best for you. All right, we've gone over the basics, pros and cons of both FHA and conventional loans. Now let's place them side by side for a direct comparison. Focus on key aspects, interest rates, loan limits, mortgage insurance, and property standards. Interest rates for both FHA and conventional loans vary based on your credit score, loan term, loan-to-value ratio generally. Generally, FHA loans offer lower interest rates for borrowers with lower credit scores because they have that private mortgage insurance and it's insured by the government. And conventional loans can offer better rates for borrowers with higher credit scores. As I said before, loan limits are another big distinction. FHA loans have set limits that vary by county to county and are generally lower than conventional loans. Like here in Seminole County, it's $500,000 versus $726,200. Conventional loans, on the other hand, offer higher loan limits, the 726 that I talked about, and high-cost areas, even more, in California, Virginia, etc. To make them a better choice if you're looking for a pricier properties. When it comes to mortgage insurance, FHA loans require an upfront premium and an annual premium paid in monthly installments, regardless of your down payment size, for the life of the loan. Conventional loans only require PMI insurance if your down payment is less than 20%, and it can be removed once your equity reaches 20%, which can be overall lower in the long term. Finally, property standards are different between these two types. FHA loans have very specific property requirements and require property appraisal to ensure the home meets these standards. Conventional loans also require an appraisal, but their property standards are generally less strict. So which scenario might be a better option for the other? If you have a lower credit score, a smaller down payment, or looking at a less expensive property, an FHA loan could be the better choice. On the flip side, if you have a strong credit score, can afford a larger down payment, or eyeing a higher price home, a conventional loan may be your best bet. Remember, everyone's situation is unique, so it's crucial to consider your own financial circumstances and consult with a mortgage broker before making any decision. At this point in the video, you're probably wondering what other videos are available on the channel. So YouTube wants you to watch this video right here.